To money and banking, and we will be covering interest rates. Looks like this is looking a little bit light on the camera. I wonder what I can do about that. But I'll have to take a look and see how I can improve that. For now, we'll have to bear with it because I don't have a solution available. If anybody has any ideas, let me know. Okay, so money and banking, and we're talking specifically about interest rates. So the first thing is interest rates influence consumption, and saving. Right? So obviously, if interest rates are high, you want to save more money and put it away in the bank. If interest rates are low, you want to be spending more money because there's really no use in keeping it in the bank. Unless you have some kind of long-term goal to purchase or something, but usually it's because you want to do consumption. And so the interest rate also influences something very interesting, which is investment decisions. Investment decisions. And what we see with interest rates and investment decisions is the following, right? If your company has an investment that could yield 2% return, right? 2% return. If you can borrow money at 1%, that's a good investment opportunity, right? However, if you're borrowing money at 3%, you're not ever going to do this investment, right? You're not going to do this investment, and the reason you're not going to do it is because you're going to lose money on interest in pursuing the investment, right? So that's very important to look at. I am just blowing through this chalk because I just keep breaking it, but it's okay. I'll learn how to use chalk more effectively. So those are the things that interest rates have a direct impact on, and so you can see that it tends to be pretty important in the economy, right? So when you look at interest rates, you're often told, okay, well, this is the APR or this is the interest rate. And so when you look at an interest rate, it's important to understand what terms you're borrowing under, right? Or in particular, the terms of repayment, right? Or the expected cash flows, right? So one of the things in order to understand expected cash flows that's important to understand is present value. Right, so if something is worth $100 10 years from now, today it might be worth $60 depending on the interest rate. If the interest rate is high, it'll be worth less. If the interest rate is low, it'll be worth more. And the reason is if you take your $60 and put it at that interest rate, you could get $100 back, right? If you take your $60 and put it into a low interest rate account, you won't get that money back and you'll get less. And so you need to put more money in to get to that 100 in the future. And that's the idea of present value, right? And so the underlying premise here is the time value of money. Now the time value of money is something that you'll keep returning to in economics and finance over and over again. And the basic premise is that money is worth more today than it is later. Anytime later. Tomorrow, in a second, in 100 years, it's worth more today. And the reason is inflation and investment opportunities. So if you have the money in your pocket, right, and somebody comes to you, and let's say you're trying to buy a car, right? You have $100 in your pocket, and somebody comes to you and says, hey, I'd like to sell you this car for $100, right? You're pretty happy because you have the money in your pocket and you spend it, right? Now, for example, imagine that you lent that money to a friend. Right? So if you lent that money to a friend and your friend now has the $100, that person that's selling the car may sell it to your friend, and your friend in turn may charge you $120 for it to make a profit. And so you have a loss on paper in how much you would have spent if you had just simply held on to the money. And that's why you would charge your friend interest, right? So loans consist of two general pieces, right? And that's principal and interest. And the idea is, from the start of a loan to the end of the loan, in some way you will borrow principal and you will end up paying principal plus interest. or you will lend interest, or you will lend, excuse me, principal, and you will receive principal plus interest, right? So when you're looking at something like that, that's kind of the way to look it over. Okay, so moving on to the actual term structures, or cash flow structures, or whatever you want to call it, the terms in which interest rate is repaid. So let me see if there are any questions before that. Directly above the blackboard, but out of frame. Okay, I might try something like that. I think that might be good. I don't know, let's see. Does that make it any better? A little bit, right? That's a little bit better. See, does that make it even better? Well, let's see if that works. And I do have actually a ceiling light that I can install, so maybe I'll do something like that for the next stream. So, we have a couple of things to consider. We have simple loans. We have fixed payment loans, and we're going to abbreviate that as FP. And then we have coupon bonds. Coupon bonds. And discount bonds. Discount bonds, which are otherwise known as zeros. Right? So a discount bond is generally known as a zero. So let's see what you guys think, if that made it any better. Yes, it's better. Okay, great. So you're right, I'll probably get a ceiling light of some sort, or maybe another directional light towards the blackboard, but there's not any glare, right? Okay, so that's pretty good. Okay, so we'll work on making that lighting more even. A simple loan is the following. The principal is borrowed at time zero, and then the principal plus the interest rate is repaid at time n, whenever it is, right? So you make just one payment all the way at the end, which includes your principal and your interest. This is important because you're paying interest on the interest every single time. You're not paying it back, right? So if you borrowed $100 in the first year, you'd owe $110, right? For the calculation for the second year, you'd owe interest on $110 rather than just $100 that you borrowed, right? In a fixed payment loan, you're borrowing the principal at time zero, and then you're paying an equal payment every single time, including the last payment. So all of your payments are spread out evenly. Usually you're paying more interest than principal in the beginning and more principal than interest at the end. But all of your payments are exactly the same. So the first loan is how you might consider lending money to a friend, right? So your friend wants to borrow $100, you lend them $100, you say, hey, pay me back $110, thank you very much, right? For the second one is how you might consider borrowing for a mortgage, right? Usually you borrow the entire value of the house, and then you have a fixed payment for the next 30 years, right? For a coupon bond, it's pretty interesting. So for a coupon bond, you borrow the principal at time zero, and then what you're doing across time is you're paying back interest. So every time interest accrues, you pay it back so that the loan amount stays at the principal. And then for the final payment, you pay both the principal and the interest. Okay, that's your final payment. And this is how companies usually borrow money, or you would borrow money for, well, actually a loan for a business would be more like this. So this is how usually companies borrow money, right? And then discount bonds work the following way, right? You borrow the principal minus the interest, and you pay back the principal, right? So to get an understanding of how that works, basically the idea is you're going to borrow some amount, let's say $60, and pay back $100. Now this looks similar to a simple loan, but the idea is that final amount is fixed, right? That final amount is fixed, and the interest is built into how you're borrowing, right? And generally, governments will borrow money like this, okay? So there's various math that we'll go through in the future about kind of how this works and how to improve it and so on and so forth, and how to calculate how you're moving back and forward. But what you need to know for the time being is that each of these will report a different interest, even though the payments or the amount paid may actually be the same, right? So that's what you'll be working through. And we'll look at the math in more detail as we get kind of into more complexity in this course, but it's important to understand the different types of loans and how interest is calculated for each one, right? So, we'll return to our illustrations for just 1 second here, just so we can go into more depth, right? So we have this, and this, right? So this is our principal and principal plus interest, right? And all we're doing here to find the present value or the future value is we're taking this principal and discounting it back, right? Or we're taking the principal and finding the future value with the interest, okay? For the fixed payments, if somebody offered you fixed payments, the way you'd figure that out is for each fixed payment, what you would do is you would discount it back. Sorry about that. Is you would discount it back. Right? And the way that you discount it back is you say, okay, well, this is 1 year from now, what's the interest paid now? This is 2 years from now, what's the interest paid now? And so on and so forth. For the third one, where you pay interest at intervals, and then you pay principal plus interest, you do a similar thing where you keep discounting each of the interests back to figure out what your present value is, and then finally you discount the principal and the interest all the way back to the beginning. And then finally with a zero, you take the principal minus the interest, and you do a similar process to what happens up there, is that you take what you wish to receive in the end and you discount it back, and that's what you actually end up lending, right? Or you take what somebody is willing to borrow or somebody is willing to lend, and you discount it forward and you receive the future value, right? So that's the basic understanding of the math that goes into this. Okay, so a couple of interesting things to remember about interest rates and about bond yields in general, right? There's an idea called yield to maturity, which we pretty much have been assuming so far, right? So yield to maturity basically means that you take the bond at the very beginning and you leave it to the very end, right? You don't sell it at some point in the middle, okay? But some point in the middle would be called your return, right? So this is a bond that extends this long, right? You're, let's say, borrowing and paying here, right? Here you're borrowing, but you're paying over here. You're paying it back in full, right? Or you're selling the bond, or whatever it is that you're doing with it. You are not allowing it to extend to the full amount. And so there, it gets influenced by the current interest rate. So for example, if you borrowed money, or let's say you lent money, right? You bought a bond, so you lent money at 5%, right? So every year you get $5, and then at the end you'll get 105, right? Pretty understandable, but you sell it right in the middle. And when you sell it right in the middle, there's two scenarios. The first scenario is that the current interest rate is 3%, and the other scenario is that the current interest rate is 7%. So if you sell it in the middle, if the current interest rate is 3%, other people can't get 5% for their money. So they're willing to pay a premium for what you're giving them. On the other hand, if you're receiving 7%, or if the interest rate is 7%, but you're only receiving 5%, you'll have to give someone a premium, right? Or take a haircut on what is owed. Okay, so that's the general kind of go-to there. So what I'm actually going to do is, since this board is better lit at this time, we're going to move it over to this board and try to do some of the work on here, and then when I figure out more even lighting, we'll do that. Okay, so this effect of the current interest rate is called interest rate risk. And besides the words time value of money, risk is going to be the word that we encounter and think about most often, because at the end of the day, that's what you're compensating, right? When you were lending your friend that $100 and missed out on an opportunity to buy a car, you took a risk, and you wanted to be compensated for that risk, right? Besides that, you were worried about interest rates changing. You were worried about your friend's ability to repay. You were worried about how you were going to pay the bills next month if your friend was a month late, right? So that's your interest rate risk. So the longer the maturity of your loan, right? So if we have two loans, or even 3 loans, the longer the maturity, the more interest rates are going to impact your price, right? The more they're going to create price volatility. So as interest rates change, that's going to happen, right? If we have the same number of changes on a shorter term loan, we're going to see smaller deviations. And on a short-term loan, they're going to be tiny. And the reason they're going to be tiny is because here you can just hold to maturity, right? So I think this is 1 year, and 6 months in it changes, right? You can hold it for another 6 months and just get what you're getting and not worry about the haircut, right? If this is 10 years and it changes 5 years in, right? 5 years is a long time, and you're going to have to compensate somebody a lot in order to take on that worse debt, right? And then finally, 30 years is going to be a very long time. So if it changes a year into a 30-year loan, right, and you've got an issue where there's 29 years left, that's going to be a problem, right? So that's what's termed as interest rate risk and volatility, right? And volatility is going to be the price impact of a change in interest rate, right? That's what you're going to be worried about, is how volatile or how much the price changes. Okay. And that's it. That concludes our lecture on interest rates in money and banking.